Welcome to Trading and Finance. Today's audiobook summary is based on Ramit Sethi's book, I Will Teach You to Be Rich. We all want to be rich, and we all want someone to help us get there. Ramit Sethi's book, I Will Teach You to Be Rich, is the answer to that wait. In this book, he explains how money works and how it can be used to our advantage. The author studied psychology and technology at Stanford University. During his studies, he made some financial mistakes. One wrong investment forced him to think about how money really works and how it can be used for oneself. His book quickly became a bestseller and features success stories from over 20,000 people. I Will Teach You to Be Rich helps you understand where your money is being spent and how you can make it work for you. This audiobook summary will explain the book's 6-week program in an easy-to-understand way. The first week will focus on improving your credit card situation. The second week will learn how to benefit from banks. The third week is about investments. The fourth week will discuss common misconceptions that hold us back, such as the idea that investing is only for the rich. Finally, we'll understand how easy it can be to maintain your new financial habits. So what are we waiting for? Let's get started with the first week, or Chapter 1. Chapter 1. Credit Card Customization. The journey to financial success begins with building strong credit. This is the first and a very crucial step. Personal credit refers to your credit report and credit score, which indicate how well you manage borrowed money. Most adults have 1 or 2 credit cards, but many people don't know how to use them correctly. If you use credit cards wisely, such as paying bills on time, not spending more than you can afford, and not carrying a balance, it can be very beneficial for you. Used correctly, credit cards build a good credit history, making it easier to get loans or buy a house in the future. Plus, you can save thousands of rupees in interest and late fees. Therefore, it's essential to view credit cards not just as a means of spending, but as a smart financial tool that can improve your financial life. A credit report is a complete record of your financial history. It shows what loans you've taken out previously, whether you paid them back on time, and what accounts or credit cards you currently have. This report includes your recent transactions, bill payment records, due amounts, and even if you've made any late payments. Whenever you apply for a loan, such as a personal loan, home loan, or car loan, banks or lending companies first check your credit report. This tells them whether you're trustworthy when it comes to repaying money. If your credit report is good, getting a loan becomes easier, and the interest rate may be lower. However, if the report shows late payments, high debt, or other negative remarks, your loan application might even be rejected. Therefore, it's very important to check your credit report regularly and keep it accurate. A credit score is a number linked to your credit report that gives a quick overview of your financial responsibility. This score typically ranges from 300 to 850. This number helps lending companies or banks understand whether you'll repay money on time if they lend it to you. If your credit score is high, like 750 or above, it means you're a reliable customer and make timely payments. Conversely, if the score is low, below 600, it indicates that there might be a risk in collecting debt from you. Therefore, when you want to buy something big in the future like a house, car, or get an education loan, having a good credit score becomes very important. A good score not only helps in getting loan approvals but can also get you a low interest rate, which can save you a lot of money in the long run. Banks and lenders decide whether to give you a loan and on what terms by looking at your credit score and credit report. Therefore, maintaining a good score and making timely payments can be very beneficial for your financial goals. If a credit card is used correctly, it can be very beneficial. The most important thing is to pay your bills on time and in full. If you make late payments, you'll have to pay interest, which increases your expenses. Essentially, when you buy something with a credit card, you're spending money you don't currently have. If you don't pay the bill on time and interest accrues, you end up paying much more than the actual cost of the item. That's why it's said that building good credit is the first step to becoming rich. Week 1, Chapter 1, Top Tips for Credit Score Improvement. These tips will help you improve your credit score and avoid common mistakes. Request your credit score and report. First, find out what your credit score is and what's written in your report. Understand what the numbers in the score mean and how they reflect your financial abilities. Check for no-fees cards. If you already have a credit card, ask your bank if your card is a no-fees card. If not, request to convert it to a no-fees card so you don't have to pay annual fees. Get a credit card if you don't have one. If you don't have a credit card, Get one, but choose wisely. Try to ensure all extra fees, like annual fees and joining fees, are waived. You can request this from the bank. Set up auto payments. Activate the auto payment option to pay your monthly bills on time. This way, no payment will ever be missed and your credit score won't suffer. Don't panic about debt. If you have credit card debt, don't panic. Instead, create a plan to pay it off. Talk to your lender and find an easy way to pay off the debt as quickly as possible. The sooner you pay off your loan or debt, the more you'll save on interest, and your credit score will improve. By adopting these simple steps, you can gain control over your money and strengthen your financial future. Choosing the right bank and accounts. When you're starting to manage your money properly, choosing the right bank and the right account is very important. Banks play a crucial role in your financial life, so it's essential to choose a bank that's beneficial for you. You should choose a bank that doesn't charge unnecessary fees and with whom you have a good relationship. This can save you from wasting money on useless fees and help you manage your money better. Checking account. Most people have a checking account, which is a common account where money regularly comes in. You can think of it like your email inbox, where new messages arrive every day. Similarly, money keeps coming into your checking account and you can use it easily. If all your money comes into this main account, you can transfer it to side accounts, such as for savings or investments. This keeps your money safer and you can invest it in the right place. You should choose an account for your checking account that offers interest and is free, meaning there are no monthly, yearly, or transactional fees. This way, you can not only manage your money without fees, but also benefit from the interest earned on your account. This is a smart way to organize and grow your money. Savings account. You should open a savings account for short to medium-term savings. This means you put money here that you don't expect to use for 1 month to 5 years. You can use this account for things like saving money for a vacation or accumulating a down payment for a house. A savings account is a secure way to keep your money and let it grow gradually because it also earns a little interest. The biggest advantage is that you can quickly withdraw money if needed, but you still have a secure fund for emergencies. Money deposited in a savings account is safer than investments, and you also earn a little interest every month, which helps your money grow. If you don't already have a checking account, open one. Double check that it has no fees. If your current account has monthly or annual fees, talk to the bank and request to have them waived. Also, keep separate money for at least a certain amount. Make sure to keep only about 1.5 months worth of expenses in your checking account and transfer the rest to a savings account. This will keep your money safe and also earn you interest. Chapter 3. Investments. Investing is something many people shy away from due to fear, but you should understand it so you can feel confident about investing. After the global financial crisis, many people stopped investing, but investing at such times is smart. After a crisis, the market is often down, and investing at this time can bring you good returns in the long run. 5 simple steps to start the investing process. There's nothing better than investing, especially when you get 100% returns, and it happens with every paycheck. All it takes is for you to get started. Everything else will be set up automatically. Here are 5 simple steps to help you begin the investing process. Pay off your credit card debt. First, pay off all your credit card debt. Because until your debt is paid off, you won't have much money to invest. Create a plan to pay off this debt and fully implement it. Once your debt is gone, you'll have more money for investments and feel more financially independent. Open a separate retirement account, IRA, or investment fund. You should open a separate account for your retirement, such as an individual retirement account or an investment fund. The purpose of this is to put your savings into a savings account. If you're saving any money, you can put it in a savings account. A savings account is a safe place where your money will grow and you'll earn a little interest. You can use it as an emergency fund. Once you've completed the 3 steps mentioned above, you'll have some money you can invest. Now consider that you can create a non-retirement fund where you can deposit money for your business or any other long-term investment. This fund will help you achieve your personal goals, such as starting a new business or investing in other funds or mutual funds. You can think about creating a diversified portfolio to reduce your investment risk and get good returns. Always remember that investing carries risk, so understand your investments well before making them. Through these 5 steps, you can strengthen your financial position and achieve bigger financial goals in the future. It will take effort initially, but as you implement these steps, you'll see that you've built a strong foundation for investing. Smart spending over strict budgeting. Budgeting is advice you often hear people give, make a budget. But in reality, doing it is much harder than saying it. Not everyone has the time to track every single dollar, where it came from, where it was spent, how much is left. But that doesn't mean you shouldn't pay attention to your money. So what's the solution? You need to learn to spend smartly. This doesn't mean stopping every expense, but rather understanding where your money is going and whether that expense is truly necessary. Here are some easy ways to spend mindfully. Differentiate needs from wants. First, fulfill your needs, then spend the rest of your money on wants. Set monthly spending limits. Create separate limits for things like food, entertainment, clothes, and other essential items. Set up automatic savings. As soon as money comes in, a small portion should go into a savings account so you save before you spend. Don't overlook small expenses. Small daily expenses like online subscriptions, outside coffee, etc. add up to a lot. Mindful spending means you're using your money wisely, and this habit will help you become rich in the long run. More important than budgeting is knowing where your money is going. That's where you need to start. Mindful spending is easy. When you receive money, your first priority should be to put it into savings and investments. Once you've done these essential tasks, you can spend the remaining money without any regret. Everyone has limited money, so it's important to spend thoughtfully. For this, we should be frugal, not cheap. What is frugality? Being frugal means you spend your money wisely. You spend on things that matter to you and save money on other things. This allows you to happily spend on things you enjoy without any regret. For example, if you like watching movies every week, that's your priority, and spending on it is fine. But that doesn't mean you have to buy a soda and popcorn every time. If you want, you can cut back a little on those things, still enjoy the movie, and save money too. Identify your priorities. Where your money goes is your right and responsibility to decide. Do you like traveling? Then spend on that, but maybe you can spend less on clothes. Do you like eating out? Then save on other things. The most important thing is to think about where you can sacrifice and where you can't. Everyone's preferences are different, so budgeting and spending are also individual. If you make your own decisions, you'll have complete control over your money and can spend without guilt. This way, you can live a balanced and happy life, where you're budgeting for your dreams and enjoying the things you love. Chapter 5. Automate your savings. The next step is to put your money into an automatic system. This means that as soon as your income arrives, it automatically goes to the right places, such as savings, investments, and necessary expenses. You won't have to manually transfer money every month. How does this system work? Initially, you'll need to set it up once. It might take a little time, but once this system is built, you won't have to worry about money every month. Your money will automatically reach the right places. An easy way to understand this is that your credit card bills also get cut automatically. Benefits of this system. You'll feel peace and confidence about your money. For example, your bills and expenses are automatically paid from your checking account, and you can spend on food, shopping, or trips without any guilt. The result is that your money works for you, and you don't have to think about every transaction every day. This is a smart, easy, and peaceful way to manage your money. Many people are afraid or intimidated by the finance industry, financial advisors, and fund managers, whereas the truth is that most people are capable of managing their own investments. If you have a little knowledge and think wisely, you can make good investments even without anyone's help. For this, you just need to start and learn a little in the right direction. You don't need to give money to others for your investments. Fund managers are not magicians. They also don't know what the market will do next. In fact, sometimes their investments fail. According to a report, about 75% of fund managers' investments do not give good returns. Additionally, mutual funds often charge a fee that is deducted from you and goes directly to the fund manager, whether their work is good or not. Therefore, if you learn a little and take sensible steps, you can make good investments yourself without paying anyone and grow your money. Index funds, low fees, better results. Index funds charge low fees and often yield better results. Therefore, don't fully trust the words of any expert. Also, just because a fund has performed well in the last year or two doesn't mean it will continue to do so. Always think from a long-term perspective and choose investments that are simple, inexpensive, and stable, like index funds. In the short term, a fund manager might perform well, but in the long run, they often can't beat the market. This is due to their fees, other expenses, and some mathematical truths that come up when choosing stocks. Meaning, when all these things add up, the fund manager's profit decreases and they generally lag behind the market. Therefore, for the long term, simple and low-cost investments like index funds are a wise option. Is investment only for rich people? Absolutely not. Everyone can invest. Whether your income is low or high, investing is not just for the wealthy. You can easily build a straightforward and low-maintenance investment portfolio. You don't need a large sum of money for this, just a little understanding and the right direction. When it comes to investing, it's important that your money isn't just in one place. You should invest in different places, such as shares of different companies, bonds, and other assets. This is called diversification, and it reduces your risk and increases opportunities for profit. So even if you start with small investments, make sure you start. When you're young, you have time to learn and recover from mistakes, so taking a little risk at that time is fine. Even if there's some loss, you can recover it over time. But as you get older, you become more cautious and prefer to take fewer risks, so caution increases with age. If you invest in various funds, you're investing in funds that follow a part of the entire market, like the Nifty 50 or Sensex. Their best performance is often good. However, investing in index funds also means you'll have to do a little research and sometimes invest in different funds. This is a bit more than mutual funds, ensuring your money is divided in the right proportions across different investments. If you want all of this to happen automatically, there's another easy and low-cost option: life cycle funds. Life cycle funds. Life cycle funds consider your age and automatically invest your money in different places accordingly. In simple terms, we can say that this is a fund of funds, meaning this one fund includes many other funds. For example, a life cycle fund can include all of these: large cap funds, investments in large companies; mid cap and small cap funds, investments in medium and small companies; international funds, investments in foreign markets; bond funds, investments in bonds. This way, a life cycle fund itself puts your money in the right place and keeps changing over time. In simple terms, if you don't want a lot of hassle and are looking for a smart automated investment, life cycle funds are an excellent option. Maintaining your system. Once all your accounts are correctly set up and you have control over your investments, maintaining your system becomes easy. You should pay attention to your expenses and keep as much extra money as possible for savings and investments each month. You don't need to log into your investment account every day because you've set up an automatic system, so your work can continue without any hassle. You just check your investments once a month and watch them grow over time. Avoid withdrawing your investments quickly, especially in your 20s and 30s. There are only a few reasons to withdraw your investments early. 1. You made a bad investment that is performing very poorly in the market. 2. You have achieved your investment goal. Good investments need time to grow and benefit you over time. Key takeaways from I Will Teach You to Be Rich. 1. Learn to use your credit card correctly. 2. Never forget to pay bills because you don't want to pay interest. 3. Automate bill payments so you don't have to remember every time. 4. Ask your bank to open a fee-free account. 5. Open a high-interest savings account and a regular checking account. 6. Keep about 1.5 months worth of expenses in your checking account. Carefully put all the remaining money into your savings account. 7. Pay off all your debts. 8. Open a separate retirement account or investment fund. 9. Decide your investment style before starting. 10. Do good research and understand where you are investing. How did you like the book summary? Please let us know. And if you want a book summary of a specific book, please write the book's name in the comments. Subscribe to Trading and Finance. Index funds have gained immense popularity among investors, primarily due to their simplicity, low costs, and the promise of mirroring market returns. Understanding how these funds generate returns is crucial for anyone considering them for their investment portfolio. Firstly, the core principle behind index fund returns lies in passive management. Unlike actively managed mutual funds, where fund managers constantly buy and sell securities to outperform the market, index funds simply aim to replicate the performance of a specific market benchmark or index. This means that an index fund, for instance tracking the Nifty 50 in India, will hold the same stocks as the Nifty 50 index and in roughly the same proportions. As the Nifty 50 index moves up or down based on the performance of its constituent companies, the index fund's value will follow suit. The returns, therefore, are generated primarily from two sources: price appreciation of the underlying securities, and dividends paid by those companies. When the stocks within the index rise in value, the net asset value (NAV) of the index fund also increases, leading to capital gains for the investor. Additionally, companies held within the index often distribute a portion of their profits to shareholders in the form of dividends. These dividends are then typically reinvested back into the fund, further contributing to the fund's growth and compounding returns over time. This reinvestment is often reflected in a total returns index (TRI), which provides a more accurate picture of an index fund's actual performance. A significant advantage of index funds in terms of returns is their low expense ratios. Since there is no active management involved, the operational costs for index funds are considerably lower compared to actively managed funds. These lower fees directly translate to higher net returns for investors, as less of their money is eaten away by charges. For example, if an index fund has an expense ratio of 0.2% and an actively managed fund has 1.5%, that 1.3% difference, compounded over many years, can lead to a substantial difference in the final wealth accumulated. This cost advantage is a major driver of why index funds often outperform active funds in the long run. However, it's important to note that index funds do not guarantee superior returns or protect against market volatility. If the overall market, as represented by the tracked index, experiences a downturn, the index fund will also fall in value. They simply aim to match the market's performance, not outperform it during bearish phases. Another factor influencing index fund returns is tracking error. While index funds aim to perfectly mirror the index, minor discrepancies can occur due to factors like cash positions within the fund, trading costs, and a need to rebalance the portfolio when the index composition changes. A lower tracking error indicates that the fund is more efficiently replicating the index's returns. The type of index being tracked also plays a crucial role in returns. A Nifty 50 index fund, for instance, tracks large-cap companies and might offer relatively stable but potentially moderate returns. In contrast, a mid-cap or small-cap index fund, or a sector-specific index fund, like a Nifty Bank index fund, could exhibit higher volatility but also offer the potential for higher returns. Long-term investment horizon is key to maximizing index fund returns. Historical data consistently shows that stock markets tend to grow over time, despite short-term fluctuations. By staying invested for extended periods, typically 7 to 10 years or more, investors allow the power of compounding to work its magic, leading to significant wealth creation. Furthermore, diversification is inherent in index funds. By investing in a broad market index, you're automatically diversified across numerous companies and sectors. This diversification helps to mitigate the risk associated with individual stock performance, providing a more stable return profile compared to investing in a few individual stocks. While index funds offer a clear and transparent way to participate in market growth, investors should be aware of certain risks. Market risk is the most prominent, as the fund's value will decline if the overall market falls. Concentration risk can also exist if the underlying index itself is concentrated in a few sectors or stocks. In India, popular broad market indices like the Nifty 50 and Sensex have demonstrated consistent long-term growth. For example, some Nifty 50 index funds have shown average 5-year CAGRs, compound annual growth rates, in the range of 14 to 15% and 10-year returns around 10 to 12%, illustrating their potential for wealth creation. Ultimately, index fund returns are a reflection of the overall market's performance minus a small expense ratio. Their simplicity, low cost, and inherent diversification make them a compelling investment option for those seeking broad market exposure and consistent, long-term growth without the complexities of active management. Embarking on the investment journey can feel daunting, but it's a fundamental step towards achieving long-term financial security and building wealth. Understanding the process in the American context involves a series of logical steps, beginning with a clear understanding of your personal financial landscape and culminating in ongoing portfolio management. The first crucial step is to define your financial goals. What are you investing for? Are you saving for a down payment on a house, a child's college education, a comfortable retirement, or perhaps a large purchase like a new car? Your specific objectives will significantly influence your investment strategy, including the amount of risk you're willing to take and your investment timeline. Clear goals act as your compass, guiding every decision you make. Once your goals are established, it's vital to assess your current financial situation. This means taking a hard look at your income, expenses, debts, and existing savings. How much disposable income do you have each month that can be realistically allocated to investments? Do you have an adequate emergency fund, typically 3 to 6 months worth of living expenses, set aside? It's crucial to have this safety net in place before you begin investing, as it prevents you from having to sell investments prematurely in case of an unforeseen expense. Next comes determining your risk tolerance. This is a deeply personal assessment of how comfortable you are with the potential for your investments to fluctuate in value, even to lose money. Are you a conservative investor who prioritizes capital preservation, or are you aggressive, willing to take on more risk for potentially higher returns? Your age, financial obligations, and emotional response to market swings all play a role here. Many financial institutions offer questionnaires to help gauge your risk profile. With your goals and risk tolerance in mind, the next step is asset allocation. This refers to how you distribute your investment capital across various asset classes such as stocks, bonds, and cash equivalents. Stocks generally offer higher growth potential but come with greater volatility, while bonds are typically less volatile and provide income, acting as a ballast for a portfolio. Cash offers liquidity but little growth. Diversification across these asset classes is a cornerstone of smart investing, aiming to reduce overall risk by not putting all your eggs in one basket. After determining your asset allocation, you'll need to choose your investment vehicles. In the American market, common options include individual stocks, bonds, mutual funds, exchange-traded funds, ETFs, and real estate. For beginners, mutual funds and ETFs are often recommended because they offer instant diversification by holding a basket of underlying securities. They can be actively managed by a professional or passively managed, like index funds, which simply track a market index. To actually buy these investments, you'll need to open an investment account. This is typically done through a brokerage firm, either an online discount broker or a full-service broker. Online brokers offer a more hands-on approach with lower fees, while full-service brokers provide personalized advice and management, often at a higher cost. Common account types include individual taxable brokerage accounts and retirement accounts like 401ks, employer-sponsored, and individual retirement accounts, IRAs. Once your account is open, the next practical step is to fund your account. You can typically do this by linking your bank account and transferring funds electronically, or by setting up direct deposits from your paycheck. Many investors choose to set up automatic, recurring contributions to ensure consistent investing, a strategy known as dollar-cost averaging, which helps mitigate the impact of market volatility. Before making any specific investment choices, it's highly recommended to conduct thorough research and due diligence. This involves understanding what you're investing in. For stocks, research the company's financial health, industry outlook, and management. For funds, understand their investment strategy, fees, and historical performance. Don't invest in something you don't understand. Once you've made your investment selections, the process of placing trades begins. Through your brokerage account, you'll enter buy orders for the specific stocks or funds you've chosen. You can typically choose between market orders, executed immediately at the current market price, or limit orders, executed only when the price reaches a specific level you set. Investing is not a set-it-and-forget-it activity. The 10th crucial step is monitoring and reviewing your portfolio regularly. This doesn't mean checking it daily, which can lead to emotional decisions. Instead, review it periodically, perhaps quarterly or semi-annually, to ensure your investments are still aligned with your goals and risk tolerance. As your life circumstances change or as markets evolve, you may need to rebalance your portfolio. This means adjusting your asset allocation back to your desired percentages. For example, if stocks have performed exceptionally well and now represent a larger portion of your portfolio than intended, you might sell some stocks and buy more bonds to restore your original balance. It's also important to understand the tax implications of your investments. In the US, capital gains, profits from selling an investment, and dividends are subject to taxes, which can vary based on whether the gain is short-term, held for less than a year, or long-term. Retirement accounts often offer tax advantages, such as tax-deferred growth or tax-free withdrawals in retirement. Beyond the initial investment, continuous learning is a hallmark of successful investors. The financial world is constantly evolving, and staying informed about market trends, economic indicators, and new investment products can help you make more informed decisions over time. Finally, remember that patience and discipline are paramount in investing. Markets experience ups and downs, and it's essential to avoid making impulsive decisions based on fear or greed. Sticking to your long-term plan, even during volatile periods, is often the most effective strategy for achieving your financial goals. The investing process is a marathon, not a sprint. While the previous explanation covered the fundamental steps of investing, there are several other critical aspects and considerations that are vital for success in the American investment landscape. These delve deeper into common pitfalls, the role of external guidance, and the often overlooked psychological factors that influence financial decisions. One of the most common pitfalls investors encounter is market timing. This refers to the attempt to predict the perfect moments to buy low and sell high. History has repeatedly shown that consistently timing the market is nearly impossible, even for seasoned professionals. Missing just a few of the market's best days can drastically reduce long-term returns. Instead of trying to outsmart the market, a strategy of consistent, disciplined investing, often through dollar-cost averaging, proves more effective. Another significant mistake is chasing past performance. It's tempting to invest in a stock or fund that has performed exceptionally well in the recent past, assuming that success will continue. However, past performance is no guarantee of future returns. Often, by the time a particular investment becomes hot, its best growth might already be behind it. Focusing on fundamental analysis and a well-diversified strategy is generally a more prudent approach than chasing fleeting trends. The impact of inflation is a crucial consideration for any long-term investor in the US. Inflation erodes the purchasing power of money over time. If your investments aren't generating returns that outpace inflation, you're actually losing money in real terms. This is why holding assets that traditionally offer a hedge against inflation, such as stocks, real estate, and certain commodities, is important, especially for retirement planning where the time horizon is decades long. While many investors opt for a DIY approach, understanding the role of a financial advisor can be invaluable. A good financial advisor, particularly a fee-only fiduciary, will put your interests first. They can help you clarify your goals, assess your risk tolerance, create a comprehensive financial plan, choose appropriate investments, and provide guidance on complex tax and estate planning matters. For those who feel overwhelmed or lack the time and expertise, professional guidance can be a wise investment in itself. Beyond just picking investments, understanding behavioral finance is becoming increasingly recognized as critical to investment success. Behavioral finance studies how psychological biases and emotional factors influence financial decision-making. Common biases include loss aversion, the tendency to feel the pain of losses more strongly than the pleasure of equivalent gains, herding, following the crowd, and overconfidence. Emotional decision-making is a direct consequence of these behavioral biases. When markets are volatile, fear can lead investors to sell at the bottom, locking in losses, while greed can tempt them to chase speculative investments at their peak. Developing emotional discipline and sticking to a predefined investment plan, even when it feels uncomfortable, is vital for long-term success. The importance of an emergency fund cannot be overstated in the American financial context. Before investing in the stock market, having a readily accessible cash reserve for unexpected expenses like job loss, medical emergencies, or car repairs is paramount. Without it, you might be forced to sell your investments at an inopportune time, potentially incurring losses or missing out on future growth. This fund typically resides in a high-yield savings account, offering liquidity and some interest without market risk. Tax efficiency is another significant component of investing in the US. Utilizing tax-advantaged accounts like 401ks, IRAs, traditional or Roth, and health savings accounts, HSAs, can significantly boost your long-term returns by allowing your money to grow tax-deferred or even tax-free. Understanding the rules and benefits of these accounts is crucial for maximizing your net investment gains. Finally, while diversification is vital, avoiding over-diversification is also important. While it's wise to spread your investments across various asset classes and sectors, owning too many different funds or stocks can dilute your returns and make it difficult to effectively monitor your portfolio. The goal is adequate diversification to manage risk, not excessive complexity. In summary, successful investing in the American context extends beyond merely buying stocks or funds. It encompasses diligent financial planning, a deep understanding of market dynamics and personal psychology, strategic use of tax advantages, and a disciplined long-term approach that prioritizes consistency over fleeting trends. Understanding market cycles. Another crucial aspect of investing in the American market is recognizing and understanding market cycles. Financial markets don't move in a straight line. They experience periods of expansion, bull markets, and contraction, bear markets. Bull markets are characterized by rising asset prices and investor optimism, while bear markets see declining prices and widespread pessimism. Recognizing these cycles, though difficult to predict precisely, helps investors manage their expectations and avoid emotional reactions to short-term fluctuations. The power of compounding. At the heart of long-term wealth creation in investing is the power of compounding. This phenomenon refers to earning returns not only on your initial investment but also on the accumulated interest or gains from previous periods. Over extended periods, even modest returns can grow substantially due to compounding. This is why starting early, even with small amounts, is often emphasized, as it allows your money more time to compound and grow exponentially. Diversification beyond asset classes. While asset allocation between stocks, bonds, and cash is fundamental, diversification extends beyond just these broad categories. Within equities, for example, you can diversify across different sectors, e.g., technology, healthcare, finance, market capitalizations, large cap, mid cap, small cap, and even geographies, domestic and international stocks. This layered diversification helps reduce risk further, as a downturn in one area might be offset by positive performance in another. The role of rebalancing. As your investments grow and market conditions change, your initial asset allocation will inevitably drift. This is where rebalancing becomes essential. Rebalancing involves periodically adjusting your portfolio back to your target asset allocation. For instance, if stocks have outperformed and now make up a larger percentage of your portfolio than intended, you would sell some stocks and buy more bonds to bring your portfolio back into balance. This disciplined practice helps maintain your desired risk level and can also be a way to buy low and sell high automatically. Investment fees and their impact. Even seemingly small investment fees can have a significant impact on your long-term returns. Fees come in various forms, such as expense ratios for mutual funds and ETFs, trading commissions, and advisory fees. Over decades, these charges can eat away a substantial portion of your potential gains. Therefore, being diligent about understanding and minimizing fees, especially for passively managed funds, is a critical component of maximizing your investment returns. The importance of liquidity. While long-term investing focuses on growth, liquidity is also a key consideration. Liquidity refers to how easily and quickly an investment can be converted into cash without significant loss of value. While your emergency fund covers immediate needs, larger, less liquid investments like real estate or private equity might not be suitable for funds you anticipate needing in the short to medium term. Balancing growth potential with adequate liquidity for your life's anticipated milestones is important. Understanding risk beyond volatility. When discussing risk, most people immediately think of market volatility. However, investment risk encompasses more than just price fluctuations. Other risks include inflation risk, erosion of purchasing power, interest rate risk, impact of changing interest rates on bond prices, credit risk, the risk of a borrower defaulting on debt, and liquidity risk, difficulty selling an asset quickly. A comprehensive understanding of these various risks helps in constructing a more robust and resilient portfolio. The psychological aspect of investing. Beyond financial theory, the psychological aspect of investing cannot be overstressed. Emotions like fear and greed can lead to irrational decisions. During market downturns, fear can trigger panic selling, locking in losses. In euphoric bull markets, greed can encourage chasing speculative assets, leading to poor choices. Developing emotional discipline, sticking to a well-thought-out plan, and avoiding constant market watching are crucial for long-term success. Continuous learning and adaptation. The investment landscape is dynamic, with new products, regulations, and economic trends constantly emerging. Therefore, continuous learning and adaptation are vital for investors. Staying informed about global economic conditions, technological advancements, and shifts in consumer behavior can provide valuable insights. This doesn't mean becoming a market expert overnight, but rather cultivating a habit of curiosity and a willingness to adjust your understanding as circumstances change. Investing as a journey. Ultimately, investing should be viewed as a long-term journey rather than a destination. It's an ongoing process of learning, adjusting, and adapting to life's changes and market realities. There will be periods of growth and periods of decline, but a disciplined, patient, and well-diversified approach, coupled with a solid understanding of fundamental principles, provides the strongest foundation for achieving your financial aspirations in the American market.